Hi there, welcome to our next video in our series for the California Restaurant Mutual Benefit Corp, CRMBC. Today we're talking about self-insured groups. My name is Kaya Stanley and I am the CEO and board chair for CRMBC. And I'm joined here again with Mike McDonough, who is the principal of McDonough Insurance and also our broker liaison and the author of the book, The Employer's Guide to Workers' Comp. Mike, thank you so much for being here.
Thank you, Kay, and good morning. And I look forward to sharing some information about self-insured groups with you.
Excellent. So in our last video, we did a comparison of traditional insurance versus self-insurance versus a self-insured group. And it's very clear across the board that self-insuring, if you're a large enough company, is absolutely hands down the best benefit for your company as opposed to paying money to a traditional insurer who is going to profit off of you. So there's a reason that the very largest companies do this, because it's one of the most financially lucrative financial vehicles that exists on the planet. And self-insured groups makes it possible for smaller and mid-sized companies to get those same benefits. And so we're going to deep dive into what is a self-insured group, how is it structured, how is it formed, and what are the benefits of it. So Mike, let's walk through the very basics of how it's formed. So CRMBC in particular was formed in 2004. And it's always a bunch of businesses that are in the same industry. So CRMBC was a bunch of restaurant owners who came together to self-insure their risk. And Mike, you've been with CRMBC from the beginning. So talk to us really high level. What is the self-insured group? How is it formed? How is it structured?
The self-insured group is formed by a group of same individuals in the same industry. So we're talking about the CRMBC, which is restaurant owners. And it's a great opportunity to self-insure just like the major corporations. However, they're doing it on a group level. So it's an opportunity for restaurant owners to pool their money, pay the expenses like any other traditional insurance company. However, the big difference here is that they get to share in the profits. So they reward themselves by reducing their overhead and costs, and they're keeping the difference in the pool and sharing that as a group.
And the way that it's structured, so CRMBC is specifically by restaurant owners for restaurant owners, but there's all different kinds of self-insured groups. There can be one for construction, there can be one for hospitality, there can be all different kinds, private schools. And it's governed by a board of directors that is made up of members. So CRMBC is governed by restaurant owners. And then it's required, it has certain regulations that we have to follow based from the state of California. And every state has their own rules and regs. So ours is governed by the Office of Self-Insured Plans. And we have to have an administrator. Ours is Path Alliance. The administrator administers the self-insured group. Then there's a third-party administrator that manages all the claims for the group. Then we have an outside actuary that looks at all of our financials every single year and makes sure that we're charging enough rates, make sure that we have enough collected or enough reserves. Then we also have auditors, we have CPAs, we have our underwriting team who's determining how much we're charging for each contribution. So it's a very structured, organized group, even though it is a nonprofit that is owned by the members, which is one of the biggest benefits. And as Mike said, when you pay into a traditional insurance company, and if you pay more rate than is needed to cover your claims, they're never sending you a check back, are they, Mike?
No, they're never sending a check back. And so that's the whole point, is that you get together as a group and you manage your costs to, reduce your costs, but also share in the profits. And so you have consistent rates year after year. And that's the difference between a traditional insurance company and a self-insured group, is that you're looking for consistent rates over a long period of time. Just like if you look at the mutual funds, if you stay in long enough, you're going to win.
So let's talk about control, because obviously one of the benefits is that when there's, and we don't call it profits in self-insurance, we call it a surplus, as you know, but the thing that makes the surplus is the control, right? Because when we're in, and it's easiest to explain this by a compare and contrast. So in a traditional insurance company, and we're doing workers' comp. So let's say you have a workers' comp claim in your traditional carrier. That claim gets handled by the traditional carrier without usually any input from you. You may not even know until years down the road that one of your claims was settled or litigated, and it was a sky high claim that you find out, and you'll get into the X mod and all of that, but very, really high level, you find out years down the road that your rates went up. Talk about how that differs in a self-insured group and how a claim is handled and how much the member has the ability to control how that claim is handled from beginning to end.
That's a great question, and glad to talk about this because there's a huge difference. The main thing I could say is there's a lot of transparency with a SIG. And from the time that injury is reported to the claims team at our self-insured group, that claims examiner, it sends out an email to that employer or that work comp coordinator. And so they're both engaged in that claim from the get-go. Then once the employee goes for medical treatment, the work status reports, they're talking about return to work. So basically the difference is in a SIG is that the claims examiner and the employer are strategizing on that claim to get that injured worker through the system as quickly as possible with the best medical care without any loss of wages.
And in a SIG, the employer actually has some say. So obviously our goal in self-insurance or in workers' comp in general is to take care of the injured worker, hands down. But sometimes it's the case that the injured worker might be a fraudulent claim, or it might be something that the employer knows that there's something else going on there, and they have the say to talk to the attorney or to the claims adjuster and say, we need to get a private investigator involved. Talk a little bit more about when those types of things happen.
Well, I'm glad you brought that up because I'm going through that right now with one of our members. And we have a situation where we have a troubled employee that keeps getting doctor's notes that she's off for 45 days. But we come to find out that one of the other employees that's involved in the interaction, we got word that she's working under the table at his father's restaurant. So what we did is we got a hold of our claims team, the defense attorney, and we've requested surveillance, and they've already ordered it prior to the deposition. So we're already on top of it, and we're looking, to control this claim and shut down the expenses and get rid of this claim as quickly as possible. And in traditional insurance, it wouldn't even happen that quickly.
Right, exactly. You probably wouldn't even know to even be able to have a say in that. Let's also talk about, obviously, the best outcome possible is that we don't ever end up in litigation. However, we often end up in litigation with these claims. Talk about the difference between when there's a claim litigated in commercial traditional insurance and when there's a litigated claim in a SIG.
Okay, I love this question too, because you're really blindsided with the traditional carrier because the law firms are hired by the insurance carrier. So in reality, the law firms are working on behalf of the insurance carrier, not so much the employer. So in a SIG, when they vet the defense firms, those law firms understand that they are working for the members and that their job is to control the cost. So their goal is to keep that claim open as little as possible, get it shut down as quickly as possible for as little amount of money as possible. But more importantly is that defense attorney is engaged. And so the employer knows who that defense firm is. In a traditional carrier, they're making all the decisions. You don't even know which law firms they're using unless you ask. And if you don't ask, they don't tell.
And not only that, we have members that literally go to every deposition, to every hearing, because they want to have a say. And they have one of the important things about keeping workers' comp claims manageable, which we're going to talk about in the next video, is having a great relationship and an engaged staff. So when the employer has a great engaged relationship with their staff and then they're sitting across the table from them at the deposition while the injured worker tells their story, that's a much different outcome than when that injured worker is sitting in a room of strangers that they have no engagement with. And you are very, very on top of that with all of your members with regard to claims reviews and things like that. Talk to us a little bit about that in particular, and then talk to us about the claims reviews that you've instituted and really made robust in our group.
Sure, I'd be happy to share. So the attending depositions, it's very important. And like you said, when that injured employee sees somebody from the employer that they've engaged with, that they know and have worked with for quite some time, when they're asked a question in that deposition, that employee really has to, pony up and tell the truth. So if there's nobody there from the employer, they can say whatever because there's nobody to dispute that. We've even found in depositions where the translator, the interpreter, wasn't explaining from the injured worker or back and forth. And so we were able to stop, go do a recess, and go back and explain what was being said. So then the defense attorney had some leverage as far as getting the proper document, responses and documentation on that injury. But by going to the depositions, it does twofold. It helps the employer understand the process more. It engages, and then it also helps the defense attorney knowing that they're working with that employer. So everybody's working in concert to make sure that we're working towards the common goal to number one, reduce the cost, shut down that claim as quickly as possible, and not let that claim remain open for many, many years like traditional insurance carriers do.
So one last thing I want to cover in this video. In traditional insurance, there's something called an XMOD, an experience modification. That doesn't exist in a self-insured group. Really briefly, because we'll dive into it in another video, but really briefly so that we can draw the link between why we're saying control is so important and why it has a direct link to your money, is the XMOD. Talk to us about what that is and how it relates to a self-insured group.
This is a great one. So yeah, like a traditional carrier versus a self-insured group, the carriers do have an experience modification and the self-insured groups don't. And basically an experience modification, it's an adjustment to an employer's premium for workers' compensation coverage. So when there's losses, the insurer has the experience from the employer, but then also the modifier, which is applied by the Bureau, that's based upon certain employers compared to other employers in the same classification. So let's take restaurant owners. So if you look at restaurant owners, there's an average rate across the board. So some restaurant owners fall below that number, and so they get a lower experience modification, they get a credit. And then if there's employers that they're exceeding what the average is on claims, then they get a debit. So it's really an advantage to an employer to really control their costs in a traditional carrier because of that surcharge. In a self-insured group, we don't have that surcharge. What we do is we compare our rate compared to the other members in the group based upon our actuarial studies, based upon what our excess premiums are for our excess carrier, based upon what our security deposit is. Based upon that, the underwriters are able to determine what an appropriate rate is for an employer in the self-insured group compared to an employer with a standard carrier and an experience modification.
And that is a huge deal when it comes to underwriting. Because, in fact, we're seeing that a lot just within the last couple of months where someone will come to us, a potential member will come to us from the traditional market, and they are trying to understand how we underwrite. And in a traditional market, you just get your rate. You don't get to have a conversation with the underwriters and with the board and with the CEO. That CEO in the big building on Wall Street doesn't care about that one loss you had. The difference in a self-insured group is we can look at someone's losses and see that they had one claim that was an anomaly, but we can look at what was going on at that time, what their losses have been and their safety program over the last several years, and the board can make a decision to take into account different factors that would never ever be taken into account in a traditional insurance, and we see it every day.
Yeah, so when you compare a traditional market to a self-insured group, for example, when we get loss runs and we're looking at somebody to consider coming into the self-insured group, we look at these claims and let's say they're 6 figures or even 5 figures. We don't even know how those claims were handled properly. And did that employer actually deserve that mod? Was that claim handled correctly? Was the right defense firm on there? So there's a lot of things and a lot of unknowns. So what we really have to do is we go back and we look at a 5-year history if they have one. If they go back 10 years, we'll look at that as well. And that really tells us a story. So we've had members come into the group that had a great history for 10 years. And then there was that 1 year and a half where something went awry. And then we look and see what happened there. And like I said, it was an anomaly. So we take that into consideration, but we look at what their history's been. And if they have good safety measures, a good HR practice, they are a cooperative member, and they get the concept of joining a group of like-minded individuals to control cost and share in the surplus. That's really what they need to understand.
Thank you so much, Mike. So that's all for this video. Join us on the next video where we're going to deep dive into yet another topic related to workers' comp self-insurance. And Mike, thank you again so much for being here. We'll see you on the next video.
Thank you so much, Kayla. Have a great day.